I'm going to say this at risk of my job, Kelly, but what President Trump is doing is insane.
Insanity as a strategy in terms of our trading
Insanity is not a strategy.
They will pay a financial price that is so big that it'll be read about in history books for years to come. Today, folks, we're talking about 5 Canadian dividend stocks investors are running to hide out during this tariff war. As we talk about those stocks, we're going to roll back to see if some of them might make their way into my portfolio as I reveal to you how much I'm down as of today in the midst of this market volatility, this tariff war insanity. We're going to talk about where the tariff war currently sits and so much more in between. So if you are on a path to financial independence, if you damn well one day want to retire, just join me because I need your help. I need the keyboard warriors to tell me, is Trump playing a manipulative game of chess, or is he just stacking a game of Jenga with the whole house ready to collapse at any time? I don't know. So I need your help because I can't tell if he's saying we will pay the price or if US citizens will pay the price, because essentially our premier, in Ontario decided that he was going to tariff electricity going down to the United States by 25% in retaliation against Trump. And then Trump is going to do another retaliatory tariff on aluminum and steel, raising it from 25 to 50% in retaliation against those retaliations. And he's talking about bringing manufacturing back to the United States like the auto industry. And I can't wrap my head around a lot of this because, GM and Ford already said, please, Mr. Trump, please. The entire integrity of the entire millions of parts that are outsourced that we bring to manufacture in the States, we can't afford to bring it all here. It's going to cause layoffs and problems. Okay, so it'll back off a little bit. Are these negotiation tactics? I can't tell because GM got bailed out in Trump's last term because their profit margins are like 3%. They're always on the brink of a bankruptcy. Like, the auto industry is very fickle and it's taken decades to get to where we are. And a lot of that has to do with global currencies as well. Like, anything you in the US buy in Canada, you're already getting a 30% discount just on the dollar conversion. And if we read through any history at all, when you're talking about the great financial price, look no farther than the Great Depression, when, the last time tariffs were largely impacted, like, significantly, but the act aimed to protect American industries and jobs by making foreign goods more expensive, but it all had the opposite effect. Other countries responded to high tariffs by imposing their own tariffs on American exports, leading to a collapse in international trade. The reduction in international trade, coupled with the retaliatory tariffs, worsened the economic downturn by reducing demand for American goods and services, leading to increased unemployment and economic hardship. We all know you're going to get more, what's the saying? I guess more bees with honey than you will shit. I don't know. I mean, you got to tell me what the heck Trump's thinking here, because he seems to want to make Canada the 51st state. And as much as U.S. citizens love that idea, Canada is not so fond of it, considering we are the largest exporter of most commodities the U.S. needs, that they are in short supply of. And honestly, Canadians are just looking at their, international trade partners, the provincial trade partners. They're loosening the laws up, and they're going to make it easier to move away from the United States, as we're seeing across many different countries, right? And I don't know what the long-term impact of this is. It's going to be volatile. It's going to be fascinating to see how all this plans out, as I try and remain biased and centrist toward all of this, obviously skewed toward the Canadian perspective, as many of you watching this are Canadian. I'd love to know what you think, because the impacts it's having on my portfolio are a lot more mild than the market might make it out to be, because I'm shocked at how little volatility so far we've experienced in the S&P and the TSX. But a lot of people, it's because they're not owning broader ETFs. My portfolio is down 2.12% as of Monday night close. We're in the midst of Tuesday here. God knows where the market's going, still to the downside, I'm sure. And as many of you are aware, I'm a guy that likes the pain, especially in the broader, larger ETFs, because I have a stock market emergency fund, which basically that emergency fund gets enacted when the S&P drops 10% or more. When we drop double digits, I double up my monthly contributions to take more advantage of the downturns. That's when I get most aggressive in my portfolio, right? But if you are degenerates out there, and I'm sure many of you are, you're experiencing far more pain than I am, because you've probably been focused on the finfluencer clown world of investments. And this includes everything from, Palantir, Tesla, Robinhood, Nvidia, Bitcoin, you name it. If you were late to the game in these kind of hype stocks, you are now getting absolutely clobbered. In the last month, most of these are down 30%. Year to date, I mean, it's crazy to see, where things are kind of at here. Like, Palantir basically giving up most of its gains from the beginning of the year. I mean, everything went through this just extreme period of volatility, with Tesla being down damn near 44% year to date, losing half of its gains from the, Trump rally when, Trump got elected. So that's the one side of the story. The other side of the story is, you're like me, you're probably more focused on the many, as I come up with this fun little quote, cost average into the many and focus on the few. which is what I do with my portfolio, right? Like I don't want to be owning dozens and dozens of individual stocks. I'd rather focus on maybe 5 or 6 and then cost average into the broader markets and continue to do so moving forward, because year to date, I mean, SAHD is still in the green, XEQT is flat. The VT, the total market's only down 2%. S&P's down 5.75. From peak to trough, we're probably down closer to 10% now. And VDY is down about 2.8% on the year. A lot of that volatility coming just within the last month or so, right? Like a lot of this tariff war has only really kicked into second gear here just within the last month. But if we take a look at my individual holdings, when it comes to like Google, Meta, Take-Two, Meta, I think these are the most resilient stocks in the market with the exception of Take-Two. We'll talk about Aduro, some of these companies, but I think Alphabet and Meta actually are the tail outliers that will benefit from this because everyone's glued to media. Everybody is probably watching more YouTube, more Instagram posts, more Facebook, more TikTok than they ever have before because of this, as they kind of become, nationalized, as their patriotic souls start coming out of their guts at the keyboards as they're typing away like crazy. I mean, all of that is only going to benefit these kind of companies, which I'm sure we'll see reflected on the earnings for Q1 with users probably up. We'll see. I think they're going to have a tail end benefit overall. But usually if this really kind of impacts into a recession, obviously marketing spend might go down. So we'll see what happens. But I think Meta, Google, easy buying opportunities here is on the year. Meta just gave up all the crazy gains that it had because of the AI hype. And Google's actually down 13.5%. Take-Two, as a stock that is way more speculative, I thought would have got hit way harder and is still up 10% on the year, which is surprising to me. And Aduro Clean Tech, obviously being a small cap, speculative play, it's actually getting hit in the line of speculation, down 20% year to date, but recently had price targets be raised to like $40 or something crazy. And we'll talk about that hydrochemolytic plastic upcycling technology in a future video you can subscribe for. But when it comes to Google, Meta, I might pick up some more Google here soon because they are the most favorable. They trade at the best price to earnings against all the S&P companies. But if we shift to the TSX and let's talk about if it's worth buying some of these companies that investors are hiding out in, because they're stocks I want to own, but I don't know if I'm better off focusing on the larger impacted stocks that are down a lot, or if I actually want more cushioning and protection in my portfolio by, again, focusing on some of these recession plays. Because if we look at the TSX, like if you look at the heat maps, you can really see that people are running into basically industries that can't be impacted by like over border trade. And some of these are even internationalized companies, right? They just don't have to deal with anything over the border, so they can operate cleanly and, without any issue here. And I'm sure people working for these companies feel a little bit more comforted that their job is probably a bit more secure. And you can tell what industries just by the tariff war discussions are impacted, right? Like lumber is starting to go up pretty dramatically in price. This is, something Trump mentions all the time. Again, aluminum and steel, these things are going up in price now, which are going to have inflationary pressures. It'll be neat to see how this all pans out over the next quarter or two when we're talking about inflation, whether the Fed will cut rates, what this means for Canada, the Canadian dollar, and so much more in between, right? But firstly, the number one stock that I think and the best place to be through this is going to be in utilities. Hydro One is a stock I've talked about a lot because it is highly focused in Ontario. It's got a lot of growth ahead of it because Ontario is a very fast growing province. Obviously, there's going to be some short-term fluctuations like we're seeing now, but still people are looking at this as a safe haven stock, which isn't a cheap stock, and it is now hitting all-time highs at 9% this year. And they have 1.5 million residential and business customers across Ontario and 87 large directly connected industrial customers, hugely focused on transmission lines over power generation for the most part. So, as people transition to the clean energy future, moving away from fuels and all this stuff, the demand for these transmission lines and the distribution of it is going to continue to go up dramatically. And they're guiding for some pretty decent growth, I think 6 to 8% earnings per share growth between now into 2027. And Hydro One is a company that's done a good job growing the dividend. It was a government spinoff going from 24 cents to 31 cents just within the last 5 years. Not like the craziest dividend scorecard, but still over the last 5 years, 5.3%, 3.6% is very healthy. This is a great company that has a very stable payout ratio. We're not talking about Google-like growth, but a great place to collect a reasonable yield, which the 2.61 is better when it was around 3%. And I don't know if it's worth buying up here. It's had a great 5-year performance, so you can't complain with a 94%, 5-year, over doubling your money in 5 years. I'm sure no one's complaining about. In the other spectrum, a lot of people like Fortis, but I think because Hydro One, it's trading for around almost the same market cap, which is quite incredible. Fortis is more diversified across provinces, some international. I think they have some operations in the United States, the Caribbean, much more diversified, trading for a better price to earnings and a much higher yield, is up 7.78%, but with a much lower 5-year growth rate because Again, it's not as fixated in one province where there's more exceptional growth, and it has had some more volatility over the 5 years, but people hide out here just to collect the reliable income, and the dividend growth went from 48 cents to 62 cents. Again, nothing stellar from the dividend scorecard. I mean, we're talking about roughly same in line over 33 years. I think slowing, in the last 5 years, but still reasonable dividend growth and a better starting yield. But I like to kind of get the best of both worlds. I want growth and income, and you get that from Hydro One, which is why it's the top of my utility list. Next in line is Waste Connections, and I've talked about this relentlessly. You can't go wrong with waste management. Our countries are still growing, the US and Canada. This one has operations on both sides of the border. 24,000 employees, 8.9 billion revenue. Continued growth is, we need continued waste management on the back of a company like Aduro, where they do have this kind of hidden upside toward plastic recycling that's probably coming down the pipe in the next decade. Lots to look forward to with the dividend. It's gone from 26 cents to 45 cents, literally doubling the dividend over 5 years. We take a look at that dividend scorecard, 12.76%. What a growth beast. Obviously, we're talking about a 0.68% starting yield, which isn't that attractive, but my God, you can't really complain when you're talking about, 5-year return of 107%. These are the kind of stocks that I love to look at, right? Total return stocks that offer great growth in their dividend, not the highest starting yield, but as a long-term oriented investor that believes in total returns. These are the kind of recession-proof, tariff war-proof stocks that you should be looking at. Now, obviously with the cherry on top of the cake, stocks that I will not buy that a lot of investors seem to love are things like Dollarama. I do go to the Dollarama to shop for snacks, treats, odds, and ends. I think everybody does. It's become a very popular store here in Canada, as I'm sure Dollar Tree, there's all kinds of them between the US and Canada that have just blown up, that have become relatively pricey stocks. But this one's up 6.8%, offering a 5-year return of 274%, which is staggering, with a 38 price to earnings multiple today, and a dividend that's gone from 4 cents to damn near 9 cents just within 5 years. That dividend growth is insane. It's 15.9%, even better than the likes of Waste Connections. There's crazy growth. And then finally, one of my favorite stocks right now that I have bought, of course, is Telus, which is actually pulling back today on the pullback of this tariff war. I don't know. I'm sure. I think this is just people taking profit after a wicked rally since the beginning of the year. It's down 4.57% since that peak. My average price was $21.50. I'm still looking at accumulating some shares here on some pullbacks. So I think Telus, the telecommunications space between the US and Canada, you can't really go wrong right now because they've been so largely impacted from the interest rate cycle that I think we found bottoms. And on the back of concerns over tariff wars, people looking for stocks that can't be impacted by over-border trade, they're going to be looking at sectors like this that have been impacted, that have potential for some return on the back of interest rate cuts, especially here in Canada with these kind of companies finally looking to see seemingly found their bottom. Time will tell. None of this constitutes financial advice. Obviously, these are largely opinions of my own as I continue to look to build up my own portfolio here with, again, my take still being on the indices for the most part. I'm just looking to buy some more Canadian stocks because VDY largely concentrates as a passively weighted ETF. It concentrates stocks like the banks, like the energy sector, sectors that are going to be hit by this tariff war, but Telus is largely underweighted. Waste Connections, Hydro One. I'm looking for some lower volatility stocks that have good yields that could offer better total returns to complement VDY as smaller positions in the total portfolio. But again, I can't help but shy away too from looking at tech companies that I think are at great discounts like Google. But I've got some cash on the side. I will be probably putting some of it to work here shortly. That cash comes from, I did my taxes. I got some tax returns. I always had a bit of emergency fund for market crashes like this, and now I'm looking to deploy that capital. And I'm getting some fat dividend checks as of March. I mean, March is a great month for getting a VOO, SEHD, VDY checks are going to be coming in. Google, I think, is paying out this month. So we should be getting a fat, probably 1,000, a couple G's coming out of this month that I'm very much looking forward to. But I'll pass that question off to you. How are you guys dealing with this? I'd love to know about your theories on the market, economics, the tariff war, all in that comment section below. But stay cool, stay awesome. And as always, I look forward to catching you in the next one.